The big question we keep hearing over and over again is, are we headed into a recession? If so, what should you do to prepare? You know the old saying, 10 of the last 8 recessions have been predicted by economists. But this time might be a little different because of the blanket tariff situation that we have going on. So tip number 1, if you have debt and you have the resources to deal with it, go ahead and start paying that off now. Some credit cards are charging 25% or more. It doesn't make sense to have a big emergency fund earning a couple percentage points when you're paying that much out on revolving debt. So go ahead and take that cash and throw it on that smoldering pile of debt to try to extinguish it, or at least pay as much down as you can. If you're not sitting on a lot of cash, at least try to commit to putting 10 to 20% of your income on that debt in a systematic basis. And if none of those are options for you, one thing you could consider is to try to surf credit card debt from one card issuer to another. Many will offer an introductory period of 0% for say 6, 12, or 18 months. Be sure you don't forget about it though, because if you go one day over, the interest could be retroactive back to day one. And if you can't surf the debt from card to card, you might think about putting that card on a home equity line of credit. Now again, we don't want you to forget about that forever because the cost of your home goes way up, but you'd rather pay 8 to 12% on a home equity line than 25% on a credit card. Next, shore up your savings. This is where we talk about building that emergency fund or building it back up. Make sure you're in a money market fund that's earning 3 to 4.25% right about now to maximize the effectiveness of those dollars. After you've built your emergency fund, make sure you're saving through your company 401k plan or an IRA or Roth IRA for your retirement. It's important not to leave that step out. And while you're building your reserves, please remember, it is still important to have fun. Don't cancel that trip. Maybe try to find some ways to cut some corners, but you're never going to make it if you're always just saving every dollar and not thinking about the next activity or the next thing that keeps you motivated. So have some fun, but keep it in perspective. If we do slip into a recession, it might feel difficult to stay invested. That's why you should be checking your portfolio allocation now in the context of your risk tolerance and your financial plan. If those things are totally out of whack, it might still be a good idea to rebalance that portfolio, get a more broadly diversified approach than, say, if you had just been accumulating U.S. stocks. There have been periods where U.S. stocks underperformed international stocks, for example, or bonds, or commodities, or other assets. Having that mix allows you to rebalance periodically, taking advantage of the market movements up and down. And the last thing I want to point out is that recessions are temporary. Take a look at this chart. You'll see what I mean. They tend to be very short in duration as compared to economic expansions. To learn more, click the link in our bio.